Emily, it's always funny with Andrew Mason, but there's some pretty serious numbers in here that were not known. There are numbers not in the prospectus, numbers that are not audited. But CEO Andrew Mason had some important new financial information from Groupon in that email to his staff. Now, in that email, he says, quote, August revenues would grow by about 12% over last month, which is a lot. Well, we cut our marketing expenses by 20%. This information is just not in the prospectus, and it's new information to investors. Of course, SEC rules are meant to restrict sharing information, material financial information, and what's more material than the biggest expense and the source of the actual numbers of revenues. So this is new information for investors coming out in a pretty non-standard way. Now, the reason this is so important is Groupon's spending a ton of cash on marketing, and the question is, how can sales grow at the same time as they are spending that ton of cash? So it's interesting because if you look at the sequential sales growth of the company, as you can see, while the company is growing really fast quarter over quarter up into the third quarter of last year, that sales growth has slowed as the marketing expenses slowed. So they're saying the sales growth continued, the marketing was dialed back in a month. We'll never know what really happened. They'll only publish quarterly numbers there. But again, this is a weird way for the company to leak information into the public markets when they might not have otherwise. Now, there is a precedent here going back to 1996 about companies releasing information right before an IPO. Wired Ventures, publisher of Wired magazine, was trying to go public in 1996. The deal, like Groupon's, was widely pilloried. Publisher Louis Rossetto sent an email to his staff trying to defend the IPO and trying to boost their morale as well. Stop me if that sounds familiar. Well, the email ended up posted online, and after TheStreet.com and later the Wall Street Journal suggested that this may violate the quiet period, the IPO was pulled. Wired magazine never went public. Groupon's fate, who knows? Now, to be sure, some rules have been changed since the failed Wired IPO, but at their heart, the securities laws demand that companies going public can sell the deal only in an SEC-approved prospectus, not an email leaked to the Wall Street Journal's blog. Emily?
Thanks, Cory. Joining us now from Palo Alto to talk more about Groupon is Vivek Wadhwa, an entrepreneur, academic, and Bloomberg Business Week contributor. And here on the set is Mark Fickes, former senior trial counsel with the SEC. Welcome to Bloomberg West.
Thank you for having me.
Mark, let's start with you. What's your take on this letter from Andrew Mason? Is he crossing the line here?
Well, the email to employees is very troubling because it appears to be designed not solely for employees, but to be designed to be publicly disseminated. With all the publicity that's been going on with Groupon, it surely seems likely that someone from the company would leak that email and get into the public domain. So the problem here is we have a quiet period, and the purpose of the quiet period is to allow investors to look at the prospectus and decide whether they want to make investment decisions based on information that's backed up by hard data. What you have here now, as Cory mentioned, is he's injecting new information about the company's finance into the public domain, and it's not subject to the same kind of scrutiny that the SEC places on a prospectus.
All right, Vivek, I'm assuming that you have some strong thoughts on this. You've been rather critical of Groupon in the past. What was your reaction to this letter from Andrew Mason?
Emily, my team took a company public in 1995. We were read the Riot Act by our lawyers, and we were told that if we even talked too loudly in the men's room, the IPO could be canceled. I don't think things have changed that much since then and now. Now, if this IPO goes through, it's going to be bizarre. It's going to change the rules for how you can communicate. So any CEO can write an email to employees, which he knows is going to be leaked out to a friendly journalist, and say anything he wants. That's not right. I mean, this IPO should be put off by at least 6 months or a year. If it's a good company now, it'll be a better company 6 months from now, surely.
Should the SEC pull this IPO, Vivek? Is that what you're saying?
Absolutely. I mean, there's so much, doubt about this company. Why should it be allowed to go out public? The SEC's job is to protect the public. Why aren't they doing their job? I mean, if they let this one go through, I tell you, it's going to really, really, really smell.
Hey, Mark, let me ask you about this. You were working at the SEC, a week ago? What rules have changed? I know that there's been some change about what companies can say and how they can communicate, looking at the Google's infamous interview, the Google founder's infamous interview with Playboy right before their IPO, or at least it was published right before the IPO. I don't really understand what's different than what it used to be back in the 90s. Could you make that clear?
Well, I think the real difference is that, again, the idea is that investors need to make decisions based on a company before it goes public, based on its financial data, and not just based on a bunch of puffery that's out there in the world. So, again, the reason that we have these quiet period rules is to make sure that investors can take a look at the financials and make informed decisions themselves, and that there's solid data to back it up based on financial statements and the other information that's included in the prospectus. And as you mentioned earlier, again, by having an email out there that has a bunch of additional financial information that hasn't been vetted by the SEC, that poses a really troubling question for the company. And certainly it's got to be giving some people at the SEC some real heartburn right now.
Yeah, Mark, let me ask you, sorry, just to follow up there. So do you think this is puffery? I mean, there's some hard numbers here about monthly change in sequential revenues, sequential and monthly change as well in marketing costs.
Well, you know, when they start providing specific information about revenues and costs, that sounds a lot more specific than just puffery. I mean, that is precisely the kind of information that, if the company is prepared to back it up, should be in a registration statement and should be vetted by the SEC to assure its accuracy and its integrity.
And their accountants? Do the accountants also have to sign off on this eventually?
Well, yes, ultimately the auditors are going to have to sign off on it, and the SEC's Division of Corporation Finance is going to have to sign off on it.
Vivek, you know, with so much controversy surrounding Groupon already, why would Andrew Mason do this? I mean, it's fair to assume with 7,000 Groupon employees that this email could leave the company.
I mean, even Mark Andreessen, if you read his Wall Street Journal puff piece, he went on about software. His conclusion was, don't worry about valuations. Groupon is like Google, a direct marketing company like Google. It's all going to be okay. It's not only Andrew Mason. These people are desperate to get this company out there before it goes bankrupt. Because if you look at all the critics, they've analyzed the data, and it smells, it seems obvious to most observers there's something seriously wrong over here. Well, if Andrew Mason is right, if things are going so well, then let's wait. What's the hurry? I mean, he knows as well as we do that there's a bubble that he needs to get out desperately before it pops. Well, let's wait. What's the hurry? That's what I would keep saying.
All right, Vivek Wadhwa, clearly a lot more to talk about here. Just in, Bloomberg West has learned that Facebook is shutting down its daily deal service, which it introduced earlier this year to compete with Groupon and Living Social. A spokeswoman for Facebook told us that after testing the service for 4 months, we decided to end the product in the coming weeks. The spokeswoman went on to say that Facebook remains committed to building products to help local businesses connect with people, like ads, pages, sponsored stories, and check-in deals. And Groupon filed for an IPO in early June, but could the online coupon provider have jeopardized its filing with this letter from CEO Andrew Mason to employees? We're talking with Vivek Wadhwa, an entrepreneur, academic, and Bloomberg Businessweek contributor, and Mark Fickes, who was a former counsel with the SEC, now works with Braun and Hagey. Vivek, got to get your reaction to this news that Facebook has now canceled its deal service. Obviously, is Groupon doing better business than the press is giving them credit for?
No, Facebook learned the hard way that this is a brick-and-mortar, old Yellow Pages style business. That you need feet on the street, you need to be offering merchants money, you have to deal with complaints, returns. It's a very expensive business, which very few companies have been able to master. Now, this is why Groupon needs more and more money, because they're losing money like there's no tomorrow, and it's money intensive. So this is why I've been so critical about it, because the business model doesn't make sense. You know, Andreessen in his Wall Street Journal article talked about software and the magic and the innovation. What's the innovation over here? The only innovation over here is in the way they figured out how to confuse the public with their Ask Away computations. There's no innovation here. It's an email scheme with some brick-and-mortar salespeople who go out and convince merchants to trust them and to sell these coupons.
All right, Vivek, hang on there.